Billionaires are hedging their positions in wake of huge economic storm. Everything is for sale. Tomorrow brings a new opportunity. What if you were more confident in your future? Billionaires have foreseen the coming of an economic storm that will change the way we value material goods. They are preparing to face one of the most severe economic storms in human history by hedging their positions. The time to prepare is running out, and we are hurtling towards a potentially catastrophic financial situation. More billionaires are implementing protective measures for their wealth and the wealth of their clients than ever before. Are you prepared? Hi there, and welcome to the first video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. In this video, we will talk about getting started with short selling, purchasing put options, investing in stocks that are immune to inflation, putting money into well-established businesses, and the diversification of your portfolio. At the same time, we will review the measures multimillionaires employ to protect them from the impending economic downturn and demonstrate how you could do the same. But before that, make sure to leave a like, subscribe if you enjoyed watching this video, and turn on the notification bell to keep posted. With that being said, let's start. The common belief that the market timing is impossible is generally correct. Despite the difficulty of market timing, it is still possible to get ready for it in advance. Billionaires often take precautions to protect themselves from potential disasters. They will be financially secure no matter what happens since they have hedged their assets. Those undertaking precautions to protect their investments may probably be the only ones to emerge unscathed from a catastrophic event. Think about Elon Musk's approach. Although Elon thinks the current economic downturn might endure another year to 18 months, he's not actively trying to time the market via stock investments. He does not assume absolute certainty about the future, but views the impending catastrophe as a distinct possibility. When assessing the state of the economy, you should never make a black and white prediction regarding the likelihood that a crisis might happen. He is not taking a chance on his potentially incorrect economic prognosis and is instead preparing for the worst-case scenario. When Elon was asked to share his thoughts on the present state of the economy, he stated that predicting macroeconomics is always difficult, and one should assign probabilities to these things. However, Elon did this very thing last year when questioned about the economy. He predicted a recession would hit in the spring of 2022. What Elon has done demonstrates that actions are more persuasive than words. In a global economic meltdown, he has chosen to cut 10% of salary-based Tesla workers. Elon has to reduce costs and preserve capital, therefore, he's slashing staff. During an inflationary situation, cash may not appear to be much of a concern, but in a recession, it is vital. This extends to institutional as well as small investors like you and most of us. After increasing its balance sheet by more than $5 trillion, the Federal Reserve now expects to decrease its monetary base over the following years. This implies the Fed can no longer just generate money out of thin air. Even if inflation keeps rising, money will be extremely scarce if the economy fails in the subsequent months. As someone who lived through the dot-com boom, Elon strongly recommends that companies save up on cash before it becomes scarce again. In an interview, Elon stated that we have to make sure we are not running things too close to the edge from a capital standpoint, and that we've got some capital reserves to last through irrational times. Because, according to him, in the past when there's been a recession, it is gone. It's flipped like a light switch. To further illustrate his point, he cited the ex-PayPal days when they raised $100 million in March of 2000. And the demand was so high they had VCs wiring money into their account without even a term sheet. Additionally, Elon said that they literally would sleuth out their bank account number and wire money in, and ask, "Where did this come from?" He stated that it was like there was fire hosing money in March of 2000. He further noted that from April 2000 onward, the market collapsed, and even successful businesses had trouble finding investors. So, for Elon, it's important to remember that in 2000, PayPal came dangerously close to declaring bankruptcy. Without raising that $100 million in March of 2000, they would have very well been out of the game. Despite his status as a pioneer in the innovation sector, Elon isn't the only business leader who cut down staff. Coinbase halted recruiting, rescinded job postings, and cut off 18% of its employees. 20% of Peloton's employees were let go, while Carvana fired off 12% of its workforce, or around 2,500 people. The underlying cause of all of these layoffs is the same: macroeconomic uncertainty. Coinbase has announced layoffs, citing the present economic climate as a major factor. According to an article published by Coinbase's Chief People Officer, L.J. Brock, we can effectively manage this macroeconomic climate and re-emerge much greater by moving swiftly and taking decisive measures immediately, paving the way for future development and innovation. Previously, we discussed how cash flow is essential for corporations. The same is true for individuals such as you. To better manage your finances, it helps to treat your life like a company. Money is coming in and money is going out. Operating cash flow is the amount of money left over after all expenditures have been deducted from total revenue. After deducting expenses like taxes, your net income will be calculated. Even though you're seeing a positive cash flow at the moment, that might all change in a matter of months. Capital protection is therefore of paramount importance. Additionally, there is a plethora of options available to protect your investments against market volatility. Among the most common is shorting of a market. Activist investor Carl Icahn oversees about $21 billion and has begun shorting the market recently. We all know Icahn is a notorious business pirate. To put it another way, he has a habit of buying up businesses, emptying them of their commodities, and then selling them off at a profit. While Icahn has earned a lot of flack, he ranks among history's most successful investors. From 1968 to 2014, he made an annual rate of return of about 26%, significantly greater than Warren Buffett's returns during the same period. Earlier in 2022, Icahn was interviewed on CNBC to discuss his concerns about the possibility of an economic downturn or recession. Icahn employs a high-risk approach, necessitating protection against significant losses. He has been buying mortgage-backed credit default swaps for commercial properties, including office buildings and shopping centers. Icahn is effectively short-selling physical establishments by acquiring credit default swaps for commercial buildings and shopping centers' mortgages. As such, it serves as a hedge from his long holdings. When you hedge, you're preparing and safeguarding your portfolio for the worst-case scenario, not trying to time the market. During a phone interview on CB Overtime, Icahn stated that they have a very large position on shorting the malls through the CMBX through a derivative, and that whole market is a huge market. He also had suspicions that the market is rigged and stated that he would be hearing from them on the subject. But he thinks that this area has problems, and certainly in the B and C malls and other real estates. Icahn further stated, "You can't ignore the fact that, and I don't know if this is a change that will continue, but you don't have people go into offices all the time anymore, obviously. And I think that this is going to militate against the real estate area, perhaps." Icahn is betting on an antiquated sector currently seeing disruption from new technologies. Leon Cooperman, another billionaire fund manager, is employing a somewhat identical approach. From 1991 to 2018, Cooperman generated an annual rate of return of 12.4%, which is 3.0% greater than the S&P 500. Cooperman, like Icahn, expects a depression and is presently 68% net long. This suggests that he is primarily bullish on the market with 68% of his portfolio and bearish with 32%. Even if many multi-billionaires are using short positions as risk management, most of you probably aren't willing to take the risk. Cooperman has claimed that investing in stocks is a great way to protect your money from inflation. He considered himself a fully invested bear prior to beginning a short position around April 2022. Therefore, he predicted a bear market but did not take short positions. Clearly, he wasn't shorting the market at all. Rather, he was merely hedging from inflation with his stock portfolio. Meanwhile, purchasing short-term put options in your current stock investments is another common strategy for risk management. Although Cooperman holds substantial positions in all three businesses, he has openly admitted he has put options on Microsoft, Google, and Amazon. Because of this, he is well positioned for the long run while remaining safe from a short-term downturn. Additionally, although investors may seem to think this is irrelevant at first, the concepts of beta and alpha make all the difference. Your portfolio's beta measures how volatile it is compared to the market. A beta of 1 represents the S&P 500. A beta of 2 indicates that your portfolio is twice as volatile as the market as a whole. The beta of your portfolio is 0.5 if it is 50% less volatile than the S&P 500. Alpha is a risk-adjusted return calculated by subtracting a part of your beta from your returns. In this manner, the volatility of your return is taken into account. If you subtract beta, it reduces alpha. Hence, a portfolio's alpha will decrease as volatility increases. You may also use this to your advantage by looking at it from the opposite side. When volatility is low, alpha tends to be high. Fund managers aim for high alpha since it compensates for the risks they take. For Cooperman, he raises his alpha by hedging his bets with put options against long stock holdings. Chamath Palihapitiya, a billionaire fund manager, is likewise getting ready for a market crisis. He states that only those individuals who prioritize alpha over beta will withstand the approaching economic storm. According to him, they have made a sub-financial decision, like the idea that he optimized for anything except the market beta over the last 4 or 5 years was kinda dumb. Furthermore, he stated that the worst thing that you could have done in that period was confusing alpha and beta. Meaning alpha is what you are able to do because of your discrete skill versus anybody else. From his perspective, the term beta describes a situation where only the market is increasing. To put it differently, he said, anyone could take any NBA player and put them on a high school basketball team, and they would be the high school player of the year. Any single one. That's beta. If you can be the MVP of the NBA, that's alpha. Recently, another fund manager by the name of Jeffrey Gundlach started a fund with the intention of addressing the present and forthcoming economic difficulties. Gundlach's mutual funds have outperformed their performance indexes yearly, and he now oversees more than $140 billion. The double-line chiller CAPE ETF is Gundlach's latest fund. The CAPE ratio is an acronym for the cyclically adjusted price-to-earnings ratio. Basically, the P/E ratio is adjusted for earnings and periodic fluctuations using the CAPE ratio. Gundlach is utilizing the CAPE ETF to identify the market's areas that are undervalued. Gundlach used the CAPE ratio since it divides a stock's price by its inflation-adjusted earnings average throughout its duration, enabling him to successfully choose the long-term winners by ignoring the short-term profit changes. These winners over the long run have been successful despite the state of the economy as a whole. Lastly, the final risk mitigating strategy you can employ is diversifying your portfolio across several markets. Ray Dalio, the king of hedge funds, for his fixation with alpha, frequently uses this strategy. By diversifying into a wide range of assets, one may feel secure in the face of fluctuating markets. Dalio's fund holdings are outlined in detail here. Inflation is plotted along the y-axis and is seen to rise and fall as the axis is moved up and down, while GDP growth in the United States is plotted along the x-axis. This chart illustrates how Dalio's portfolio consists of high-performing assets regardless of the overall economy's health. Therefore, Dalio's fund can be considered macro-neutral. He can raise alpha while decreasing volatility by including multiple asset classes in his portfolio. This is due to the fact that you are integrating uncorrelated assets with essentially identical long-term returns. Dalio made this tactic famous by calling it the holy grail of the hedge fund industry. The ways that billionaires hedge their holdings vary widely. As individual investors, we may pick whichever option best meets our needs. To maximize alpha, investors can utilize a single strategy from this list, or they can combine several of them. Keep in mind that timing the market almost never works out well. It is incredibly challenging to time the market, and doing so would require you to either go all in with all your money or maintain 100% cash. Each of these tactics has a poor track record and usually results in financial ruin or missed opportunities for investors. Thank you for watching this far. Please leave a like, subscribe to help us expand our future audience, and comment below your preferences in terms of hedging your position amid this economic storm. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and look out for the next video.